Why is cost of capital important? WACC, the return to the investor, is a cost to the company. A firm's cost of capital gives the company an indication of how the market views the risk of our asset. Knowing our cost of capital can help us determine our required return for capital budgeting. Required return is the same as discount rate and is based on the risk of the cash flow. Need to know the REQ return before we compute NPV and make our decision on whether or not to invest. Must earn at least the REQ return to compensate investors. These all refer to opportunity cost of using capital in one way versus others. REQ return from the investor's point of view, cost of capital company's perspective, appropriate discount rate you set in NPV calculations. Capital can be in the form of debt, bank loans or bonds, equity stocks. Cost of debt. Cost of debt is YTM, not coupon payment. This is the REQ return on our company's debt. Cost of equity. The return to investors is an unobservable cost to the firm. It is the return required by equity. Investors, given the risk of the cash flows from the firm, can earn a return on equity by dividends or cap gains. The two methods to determine cost of equity are dividend growth model, CAPM. Dividend growth model approach. Solve for RE, P0 equals D1, RE RE equals D1, P0 plus G. Advantages of dividend growth model. Easy to understand and use. Disadvantages of dividend growth model. 1. It's only applicable to companies currently paying dividends. 2. Not applicable if dividends aren't growing at constant rate. 3. Extremely sensitive to the estimated growth rate. 4. Does not consider risk well. CAPM, SML approach. RE equals RF plus B. Advantages of CAPM. 1. Explicitly adjusts for systematic risk. 2. Applicable to all companies, as long as we can estimate beta. Disadvantages of CAPM. 1. Have to estimate M-risk premium, which varies over time. 2. Have to estimate beta, which varies over time. 3. We use the past to predict future, which is not always reliable. Cost of preferred stock. Preferred stock generally pays a constant dividend each period, assumed forever. Preferred stock is a perpetuity, so we use the perpetuity formula and solve for Rp. Rp equals d, P0. WACC, weighted average cost of capital. Use individual cost of capital to get overall cost for firm's assets as a whole. This cost of capital is the REQ, return on the firm's assets, L, based on the market's perception of the risk of those assets. Weight is determined by how much of each type of financing is used. Use MARKETVALUE to determine weights. Capital structure weights. E equals market value of equity, D equals market value of debt, V equals market value of the firm equals D plus E. Weights. W equals E, V equals percent financed by equity, WD equals D, V equals percent financed by debt. Why do you use market value instead of book values? Because you will get a better return. Taxes and the WACC. Since we are concerned with after-tax cash flows, it is important to know the effect of taxes on the costs of capital. To this end, interest expense will reduce our tax liability, which in turn will reduce our cost of debt. After-tax cost of debt is road. Are dividends tax deductible? No, dividends are not tax deductible, which is why there is no tax impact on the cost of equity. WACC equals WR plus WDRD. What is WACC? WACC is the overall return the firm must earn on its assets to maintain the value of its stock. It is also a market rate that is based on the market's perception of the risk of the firm's assets. What factors influence a firm's WACC? 1. Market conditions like interest rates, tax rates, and market risk premium. 2. The firm's capital structure and dividend policy. 3. The firm's investment policy. A firm that takes on riskier projects will have a higher WACC. What do you use to find cost of equity? I use CAPM, RE equals RF plus B. What do you use to find cost of debt? I use YTM on existing debt, use TVM. Explain risk-adjusted WACC. Since it depends on the risk of the project and not the risk of the company, a project's cost of capital depends on how the dollar is used, not where it came from, the source. When should you not use WACC? Do not use WACC when projects do not have the same risk as the firm's current operations. In this case, we need to determine the appropriate discount rate for that project. In general, a company will have a lower WACC than a specific department. When would you accept a company's WACC? Except when the given WACC percent is less than the given IRR. When should you accept a company's required rate of return? Except when the given IRR is more than REQ return. What two methods do we use to calculate the required return for a division or risky project? Two methods: pure play approach and subjective approach. Pure play approach. Here, you find one or more companies that specialize in the product or service that we are considering. You then find the beta, and take an average. You then use that beta and CAPM to find the appropriate return for the product with that risk. This is often difficult. The subjective approach. Here, you consider the project's risk relative to the firm. When the project is less riskier than the firm, use a discount rate less than WACC*. Your error rate should be lower than not considering other tasks.